Hello dear algorithms traders. A question that occupies every trader is, how much return can you generate with trading and how much money do you need to be able to live on it? We will deal with exactly this topic today and look at different models. We will look at the returns of the most successful institutional traders as they are more comparable to a retailer than a large big player. Of course, we will also critically examine and question some statements from different trading coaches. All in all, an exciting topic that we can look forward to. A daily turnover of $400 billion is generated in the futures market, $8 trillion in the foreign exchange market, and around $400 billion in the stock market. That puts the total sales volume at just under $9 trillion per day. We have often spoken extensively about the profit and loss ratios of retailers in the individual markets. Overall, this results in a total retail loss rate of 89.5% averaged across all markets. 5% of all participants are on the break-even point, however, they still do not earn any money with it. Although 5.41% of all market participants earn more than they lose, unfortunately only about half of all participants can live on their profits. Many trading coaches take advantage of this dream of becoming a multiple millionaire with just a few mouse clicks, because they cannot manage to be successful with their own trading. And the new perversion of cross-selling shows that the trading coaches themselves don't earn enough with their useless seminars. Here, the trading coach tries to persuade his customers to consume other products in addition to the original seminar fees. A lot of money is also made from the broker recommendation. There is a 20% commission from the foreign money provider, 20% for the software, and of course the participants are motivated to attend further seminars. That's why there are only small appetizers in the trading seminar. As if that wasn't enough, financing is now even offered. A trading coach says, just imagine how much time you lose if you first must save up my seminar fee. With the financing from me you will reach your goal faster. In return, the trading coach also receives a 5% commission from the bank. Stay away from such a loan because it's just a rip-off. Perhaps the coaches should consider sell private health insurance in the future, because there is a significantly higher commission for this. And maybe also legal protection insurance so that the participant can defend himself against the ripoff. But since most trading coaches are based abroad, this will probably be a little more difficult. I once took the trouble to produce a funny video about a trading coach for you. Incidentally, any resemblance to living persons is purely coincidental, and now enjoy.
Hello, this is Peter, and Peter is poor. This is a person who has very, very little money. That may sound funny, but that's how it is. And this is his daughter Eva, who has had to pay for everything for him so far. It's expensive for his daughter, but unfortunately that's the way it is. Peter found fake banknotes in his daughter's closet. This is worthless paper with such large numbers printed on it. And then Peter suddenly had a great idea. That may sound silly, but that's how it happened. Peter then posted a trading video on YouTube that he earned 30,000 euros in 20 minutes. That's a lie, but Peter doesn't care. The reaction of the spectators, people who believe what Peter says, was enormous. That was indeed very mean of Peter, but unfortunately it can no longer be changed. And then the viewers called like crazy and absolutely wanted to buy a seminar from Peter. Seminar is like in school when the teacher tells things that no one understands. It's incomprehensible that so many have called, but Peter was still very happy about it. And so, Peter earned 5,000 euros 200 times and became a millionaire overnight. By the way, this is a person who has a lot of money. And the nice thing is that Peter has never traded real money on the stock exchange. It's not nice, but it's good for Peter. Peter flew first class with his daughter to Dubai. There, Peter can sit not far away from the pilot. In Dubai, the two want to visit another trading coach who thinks Peter's idea is very good. It's very exhausting for Peter, but it's worth it for everyone.
Well, I have to say, that That was almost funny.
Yeah, yes, but they have to be careful, otherwise they will lose their bad reputation.
Unfortunately, there are a lot of lies in the stock market. Let's imagine that with 4 trades a day, a trader makes 12,000 euros in profit a year. With only 500 euros in the account, he earns 1,000 euros a month. That equates to a monthly return of 200%. Is that really realistic? To check this, let's first look at how the ROI, i.e. the return on investment, is calculated. The formula is profit by total capital times 100 equals return on investment. For this we first need the turnover minus costs, minus the taxes, gives the profit. And equity plus debt equals total capital. A company makes 250,000 sales minus 100,000 costs, minus 50,000 taxes, gives a profit of 100,000. The company owns 500,000 equity and 500,000 debt, giving a total capital of 1 million. This results in a return on investment of 10%. There are other ways of looking at things, but we are neglecting them today. So now let's analyze our yield king. Sales 20,000 minus cost 4,000, taxes down, gives a profit of 12,000. His equity, i.e. the margin at the broker, is 500. Since he trades with one lot, he gets 99,500 from his broker. This reached a total capital of 100,000. The return calculated from this is 12%, but not per month, but per year. And so, with the right calculation, we come from a utopian return of 200% to a realistic return of 1% per month. Thus, the return calculation for a company refers to the debt and equity, with private capital standing out. In trading, the return always refers only to the total capital traded. The maximum risk here is 12%, since the broker shoots the trade with a margin of 50%. However, it may well be that the trader is willing to use 20,000 euros for speculation, but only has 2,000 euros in the broker account. This significantly increases its future liquidity. When we talk about returns in trading, the first thing a trader must do is break even. And for that you need a few years of experience. Of course, there are different influencing factors in trading. Let's take a look at the components for the return. First of all, strategy and setup is the key factor. Likewise, the number of lots, take profit and stop as well as spread, profit rate tax burden and the number of trades. But the return does not depend on the capital that is in the broker account. 2,000 are in the account, we trade one lot and leverage 200. Win rate 59%, spread 0.5 and stop 1.5 pip. The net RRR is 1.5, as a minute scalper 20 trades are completed daily, the capital gains tax is calculated without church tax. This results in a net profit of 18,500 euros. That equates to a monthly return of 1.5%. Now we increase the spread a bit, e.g. through increased volatility in the market, and the profit is already reduced by 17,000 euros and the return is only 0.1%. We leave everything as it is and only increase our win ratio to 65%, thereby increasing the return by 1% per month. Now we increase the number of lots to 5 and we see that the return has decreased by 0.3%. This has primarily to do with the new trader tax, which also has an impact on the return. When it comes to the question of what return can realistically be achieved, let's first look at the most successful hedge funds in the world. The top 10 hedge funds under $10 million under management have achieved annualized returns of 75.9% over the past 12 years. This corresponds to a monthly return of 6.3%. The top 10 hedge funds with over $10 million under management have achieved annualized returns of 91.16% over the past 12 years. That's a monthly return of 7.6%. It is noticeable that the more capital available, the higher the return. And we recognize that yields are also falling very quickly. On average, the first 3 places achieve 120% and the last 3 places 50% per year. While that's still good, let's not forget that there are some 1,000s of hedge funds out there. I have now calculated an average return from these best hedge funds and extrapolated downwards to smaller accounts. Let's see if these approximations are correct. That depends on the factors I mentioned earlier. Here we now see the calculation with 1 lot, the calculation with 2 lots, the representation with 5 lots and with 10 lots. Of course, these are all theoretical values. However, there are some influencing factors that significantly reduce the return. Imagine you want to complete 14 trades in a certain period of time, but unfortunately the current market situation does not allow such a number. If you still try to hit those 14 trades, your win rate will go down significantly, reducing your returns. For this, it is important to create a kind of trading life balance. We will talk about that in more detail in my next videos. In the last video, we talked about the fact that the big players provide institutional traders with volume data from the Forex market. There is now much more light in the Forex market, which will affect the profit rates of Forex traders. Of course, there is lighter in the futures market as the larger market participants have significantly more information to locate individual retail traders. The futures 6E trades $23 billion per day. Converted to 100,000 contract, that would be 230,000 lots. So, 160 lots come onto the market every minute. The largest institutional traders achieve a turnover share of about 50%, smaller institutional traders and retailers make up the rest. This means that 80 lots come into the market every minute, which do not come from the larger market participants. If someone enters the market with 10 lots, that's already a turnover share of 12.5% in this minute. In the Forex market, this share of turnover is of course significantly lower due to the size. This means that in the futures market you stand out much faster with 10 lots than in the Forex market. Although I've noticed myself that if I'm trading more than 10 lots in Forex, they'll get me out faster and my profit rate will drop. Another important point for me is how long it will take for me to reach break-even for one trade. It takes an average of 30 seconds during off-peak hours. During peak trading hours, I'm break-even within 15 seconds. And only then does the money-making begin. Another important aspect is the pip value per minute that I developed. Here the risk is compared with the RRR in order to exit the trade at the optimal time. Likewise, we know that the larger the RRR, the higher the probability of being stopped out. Trading coaches are always happy to tell you that they have a win rate of over 90%. Of course, this is possible with a RRR of 0.1. At the same time, this means that I have to make 9 trades to compensate for a losing trade. And that doesn't make any sense at all. So don't let the horse tell you anything. A high win rate means nothing and must always be seen in relation to the RRR. And of course, many other things are also important. So that I can use as many trading opportunities as possible, I work with a stop of 3 ticks and a net RRR between 1.5 and 2. And that actually only works as a second scalper. For this, however, one must also fall back on the stock market data. With equity of 1,000 euros, you can of course trade 200,000 euros in the market. But that's no use if you're willing to take a maximum of 1% risk. If I trade with 1 lot and a risk of 1%, then after only 1 pip it's over. With a capital of 10,000 euros and 1 lot in the market, you reach a stop of 10 pips. These things must also be considered because they significantly affect the return. As we all know, futures trading will become significantly more expensive in the future due to the abolition of the obligation to make additional payments. This automatically reduces the return and at the same time increases the risk. An equally important point in trading is to find the limit of the feel-good factor. This means generating an optimal return for yourself with as little stress, risk and losses as possible. This means that a monthly return of 3 to 4% is possible for a professional trader. However, that depends on many different factors that we discussed today. My approach is not about earning as much money as possible within a short period of time, but about generating the best possible price-performance ratio. The more trades are processed, the more empirical values are added. It is only about often repeatable small amounts. If I win 100 euros and lose 20 euros at the same time, I can live with that. That's not to say that it's not possible to win 30,000 euros in 20 minutes. You can win 1 million euros in the lottery in 1 minute. The only question is how often you can repeat that. And someone who earns 30,000 euros in 20 minutes will never voluntarily pass this knowledge on to others. Unless it's just a coincidence. You may have seen in this video that you don't need a lot of capital to make a living from trading these days. Many factors have an influence on the return, which can be individually optimized. Don't forget the time factor either. We know our life is limited and everyone always has to ask themselves what is more valuable: time or money? I wish you a great weekend, have a good time, and I'm sure we'll see each other again soon. Best regards, Michael.